Have you ever wondered how much of your investment portfolio gains are actually eaten by inflation? I believe we all know that we should invest so that thanks to less we have at the moment, we could have much more in the future, right? But with the inflation levels that we could see in the recent years, is it even worth it? What part of your portfolio is eaten by inflation across the years? Hi, I'm Daniel, and let's take a closer look on this topic. Before we can talk about how inflation impacts your investment portfolios, we need to understand what inflation actually is. Inflation is the rate at which the general level of prices for goods and services rises. What means the main effect of inflation is higher cost, lower real wages, and eroded savings. Okay, for example, I will not go for the extreme details because inflation itself is the topic for another at least hour-long video, but simply said, let's say that you have some item, let's say mobile phone, that you could last year buy for $100. The inflation for the mobile phones would be 5% last year, what means that this year you can buy the same mobile phone for $105. You see, original price plus inflation. What means that in case your wage stays as it is, or it grows slower than the actual inflation, you can buy less stuff than you could last year. And also every goods and services has different levels of the inflation, but in the end you get every month reported levels of inflation in your CPI report by the government, in which they inform you what the combined inflation rate was in the previous month. So it's not like government will say the inflation is 2% and it's actually have to be 2% for everything. It might be 1% for milk, 1% for bread, but for example 5% for services, 6% for housing, and so on. And in the end you know the combination of all of those inflation combined. So, as we know already what inflation is, let's take a look on how it actually impacts our investment portfolios. Okay, this video is not an financial advice, but let's say for this video that we are investing into the SP 500. The SP 500 is a stock market index tracking the 500 largest US companies. So thanks to investing into the SP 500, we reached that we have quite well diversified portfolio and we can expect the average annual return on the levels of the 8 to 12%. Of course, those are the numbers before inflation, and watch out because past performance does not guarantee future results. Okay, but let's take a look on actual numbers. As I mentioned already, by investing into the SP 500, you can expect average annual return on the level of the 8 to 12% before inflation. Of course, depends on when you started investing. When you started to investing on the top of the dot-com bubble, of course your earnings are lower than in case you would start at the bottom of the financial crisis at the 2009. So your average annual performance may vary, but in the end, those are the real numbers from last 10, 20 and 50 years. So in case you would be investing into the SP 500 in the last 10 years, your average annual return would be over 13%. In case you would be investing in the last 20 years, that means from the 2005 to 2025, your average annual return would be only around the 10.5%. And in case you would be investing for the last 50 years, your average annual return would be 12.39%. So as you can see, it varies depending on how long you are investing and where you actually started with the investing. Okay, so that would be your average annual gains of your portfolio. But let's take a look on what was the actual average annual inflation rate during those years. So in the last 10 years, the average inflation rate was on the level of the 3.13%. Not great? Not terrible, okay? Last 20 years, it was on the level of the 2.55. So, longer period, it was on the much lower level. Quite good. And the 50 years, here it was once again over 3% and actually 3.68%. Those are of course only the average levels. That means at some year it could be 0.5, at another 6%. But in the end, those are the average inflation rate throughout those years. But of course, as I mentioned already, every goods and services has different level of inflations. That means that housing could go faster than 3%, but for example, milk could go slower than the 3% yearly. But those are the averages from the CPI report that we can get from the government every month, year, and so on. Okay, so those were basically our gains and our losses of our portfolio, which are eaten by inflation every year. Now let's take a look for the bigger picture to see actually how it looks cumulated across those years. So SP 500 cumulated in the last 10 years you would be up 250% only by investing into the SP 500 with the dividends reinvested, okay? So now when we will take a look on performance of the last 20 years, we can see the cumulative performance of over 600%. That's obviously quite good. But in case we will take a look on the cumulative performance of the SP 500 for the last 50 years, 34,286%. So basically, in case you would invest $10,000 50 years ago into cumulative SP 500 ETF, you would have almost 3.5 million US. That's massive. But now let's take a look on cumulative inflation rates, okay? So in the last 10 years, the cumulative inflation rates were at the level of almost 36%. Looks like nothing special, okay? 36% looks okay. For the last 20 years, the cumulative inflation was almost 65%. That's already quite a lot for just last 20 years. And for the last 50 years, the cumulative inflation rates were at the level of the almost 500%. What means that in case you would go buy this mobile phone for $100 50 years ago, nowadays the same phone would cost almost $600. But of course, that's only example. But 500% of cumulative inflation, it's quite big. And now, as we are almost at the end of this video, let's take a look on how those cumulative inflation rates actually impacted our cumulative SP 500 performance. So in case you were investing into the SP 500 for the last 10 years, of course you are up 250%, but thanks to inflation, it's in the end only 159%. In case we will take a look on the 20 years levels, we can see that the inflation of the 65% ate almost half of our original gains from the SP 500. So in the end, we are 342% up. What of course is still great, but it's much lower than the original 633%. And now let's take a look on what we actually got from the 34,000 gains in the last 50 years. So before we were 34,000% in the profit, after 500% inflation, we got 5,568%. What means that in case you would 50 years ago invest $10,000 into SP 500, even though you would have almost 3.5 million US, in reality, as everything got more expensive, you got only around like 550,000 US. What, by the way, once again is a huge number, of course. From the 10,000 go to 550,000 US by just putting your money aside for the 50 years. It's really impressive. But this is what the inflation rates across the last 10, 20 and 50 years will make with your gains in your portfolio. But of course, this video was not made to disgust you from the investing. Inflation is there and was always there. During my studies at the university, I heard this quote: "People prefer certain losses over possible gains." What means many people will simply put their money into the bank and make them sitting them for all those years. What means their money will for sure lose those values, but instead, in case you would risk and you would invest into the SP 500 across those years, you would have 160% more, 340% more, or 5,500% more than you originally invested back in those years. So in the end, what I probably just wanted to point out is that you simply cannot watch on only gains and losses and exchange rate risk, but also on the inflation levels and how those will actually impact your investments in 10, 20, 50 years in the future. Okay, so in the end, investing is still the best way how to improve your financial situation in the future. So even though you can see that inflation will eat part of your investment portfolios and of your gains, do not be scared of it, but simply calculate with it while you are planning your financial future. Okay, so in case you would like to see more videos like this, that means finance, investing, analysis and many more, don't forget to hit the like and subscribe as well. But for me today, that's really all. Thanks for watching, have a nice day and see you all at the next video. Goodbye.